Well, good morning. I'm Marlon Bowling with you, your tour guide to the ag commodities. So glad you could join us today. I am joined by none other than Brian Hoops. Now, he's the president of a company called Midwest Market Solutions. He's based out of Springfield, Missouri, but they have offices all over the western part of the Corn Belt. And he joins us right now. Kind of a softer tone in the overnight trade, Brian. I did not see any overnight export sales mentioned this morning. Did you?
Yeah, good morning, Marlon. No sales this morning to report, so that could weigh on things this morning. We had a couple sales of corn in a row, a sale of soybeans, first one in 3 days, and that was seen as positive by the trade with a big rally in both corn and soybeans. And now we may view this lack of sales as an indication that maybe this rally kind of stalled some demand, and we need to pull back in prices to uncover that demand again. And so it's all about price discovery. It's all about finding the news and the fundamentals that's going to drive prices longer term. And we just don't have really a lot of news to go off of. We're looking at some technical action. We ran buy stops yesterday as part of that big rally, but with a higher U.S. dollar this morning, I'm afraid that corn and soybeans could slip a little bit here off of where they closed the overnight session down just a few pennies.
Well, let's take a look at where we wrapped up the Globex trade here. And with our quotes provided by bar chart, the corn market just barely weaker by the time we wrapped up that overnight session. Of course, a lot of traders wonder how much merit you can really put into that overnight trade. It chops around so much, but we had December finishing up at 544.5, and that was down just 3/4 of a cent. Now, if we look at that soybean trade, we had the November contract down 3 cents overnight at 13.28 3/4, but still way above that $13 benchmark. And looking at the wheat in Chicago on that December contract overnight, we were at 7.22, down 10 1/4. All kinds of pressure in that Chicago wheat market again. Kansas City wheat on December down 5 1/4 at 7.12, so it only lost about half as much. Meanwhile, the Minneapolis spring wheat trade barely lowered. December down a penny and 3/4 at 9.09 per bushel. Brian, when you look at the action here in the grains, and you look at, I want to bring up a December corn chart here for one thing. I'm hearing a lot of anecdotal stories that some of the harvest is starting now this week in the southern portions of the Corn Belt. Are you hearing of any in your region of the country there? I had heard also that maybe in southeast Kansas they may get underway this week.
Yeah, I think there'll start to be some in parts of Kansas areas. Certainly they're cutting a lot of silage up north where it's been very dry in the northwest. A lot of places in Iowa and the Dakotas are cutting silage already. I just talked with a client this morning in Texas who is harvesting corn, and so they're going like great guns trying to get their corn harvest done, and they're progressing fairly well. But there's corn harvest that is starting and will continue, and that will continue all the way for the next several months. So we're going to see, the pipelines get filled up with corn a little bit. And I think that is going to affect basis in a lot of areas. In my area, it's an extremely tight basis importing corn into our area. But as we start, as you mentioned, harvest starting in parts of Kansas, that pipeline will start to get filled up a little bit again, and basis levels probably going to ease off at least for the near term.
Now, there were some areas of rain overnight, pretty heavy rain at that. Is that partly what weighed on the overnight grain trade then?
Rain at this time of year is viewed as beneficial. You have a late filling of soybean pods and ear fill on corn in some areas, so it is viewed as being beneficial to the crop. So certainly, if as long as you don't have any high winds or hail along with it, or something else, it certainly should be viewed as beneficial, and that is going to pressure prices.
Okay, I'm going to take a break right here, Brian. We will come back here in a moment. I want to talk with you about livestock trade, but I have a little follow-up question, and it's related to the expiration of options and deliveries coming up. We'll talk about that right after this. Right before the break, I was asking Brian Hoops, who is our guest right now, about the upcoming option expiration for September options. Now, that comes up this Friday, correct? Does that have an impact on the market?
Usually it does, Marlon. We have option expiration Friday and then first notice day against September grain futures. So longs need to be out of their positions in September grains by Monday's close, so you risk delivery on Tuesday. So usually that does affect us. We usually get a little bit of weakness going into the delivery period and then a rally afterwards. And we go into the option expiration, we could see a little bit of a rally. We could see a pullback in prices in here. Kind of depends on where those options need or want to expire worthless to make as many worthless as possible. It does give us usually some sort of a rally after we get through that delivery period, and that comes next week. So that's something to watch very closely.
Now, that's an interesting statement. You want as many to be worthless as possible. How does that work?
Well, yeah, a lot of that's the old trade anecdote is they find out where the strike price has most open interest, and the long calls want to the traders want those to expire worthless. If you're short the call, that's how you make the money. Is those options go off the table at worthless, and the long holder of those options is is the one that loses the money on that. So sometimes that has an effect. If there is a strike price that has a lot of open interest in it, that's the one that kind of the market gravitates towards.
All right, let's take a look at our close on our livestock trade yesterday and talk about the cash livestock movement yesterday a little bit. On the live cattle board yesterday, we had October 25 lower at 131.70. The deferreds were 40 to 50 higher, though. And on the feeder cattle market yesterday, we had the September contract down $1.52 at 165.77. That was not too far from the low of the day. It had been several dollars higher than that at one point. On the lean hog trade yesterday, we had the October contract, the lead month, 50 cents lower, and it was at 86.97. That'd be exactly $1 off of its high of the day. Interesting in the lean hogs how you had the most weakness in the deferred contracts. What did that mean?
Yeah, you did. And that is a little bit of a surprise because those markets are already heavily discounted. The hog weights came out this morning a little bit earlier, and they were down almost a full pound from a week ago, a couple pounds below last year. So that should be supportive for the hog market today. But that hog market seems to be kind of one that's just following technical trends right now. If you're able to take out previous day's highs, a lot of buy stops above it, and the market seems to rally. If you can't, the market turns lower on some profit taking, and that seems to pressure the market. The cattle futures had what we describe as a real strong breakout earlier this week, and now we could see that market pull back here. Maybe that breakout point becomes support. Cutout values are down, and so that does suggest that we could see some weakness in the futures market over the next couple of days on a little correction.
All right, thanks, Brian, for the comments this morning. And in case you're wondering, the dollar index is up 139 points this morning. It's back over 93. We'll see if that has an impact, too. Brian Hoops with Midwest Market Solutions. Janet, back to you.